Thanks for clicking. Canada's inflation rate continued to surge in the month of February, up to a new three-decade high of 5.7%.
Holy sh**.
Our higher inflation rate came as little surprise as the US inflation rate, which Canada usually closely follows, although a few months behind, came in at 7.9% last week, which has increased calls both in the US and Canada for higher interest rates. So what I want to do today is go over Canada's inflation rate, discuss how the war in Ukraine is likely to affect Canada's inflation rate going forward, and then discuss what we're likely to see from the Bank of Canada vis-a-vis interest rates due to this war in Ukraine. The Federal Reserve is set to release its interest rate policy this week, and we're also set to receive the Bank of Canada's interest rate policy in the coming weeks as well, with more and more pressure, more and more calls for the bank to raise interest rates to get this inflation rate under control. Click like and subscribe if you want to get those updates, but for now, let's get into our inflation rate. Canada's inflation rate for the month of February came in at 5.7%, which setting a new three-decade high, with the last time inflation being this high being 1991. This high inflation rate is likely to put even more pressure on the Bank of Canada to raise rates once again. They already raised them once this month by 25 basis points, and this will likely put more and more pressure to continue that raise in the month of April. Well, this inflation rate is obviously extremely high, especially relative to that which Canadians are accustomed to seeing. We're used to seeing between 2 and 3% inflation rates. I think it's important to remember that this inflation rate is February's data. So this was before we had the huge rise in gas prices. This was before the invasion of Ukraine. And this was before the Russian economy was sanctioned to near collapse.
Well, hindsight.
However, just in a few weeks, we've seen gas prices rise 16%, up 46% from this time last year. In addition to gas, food prices are expected to rise another 14%, and they weren't exactly cheap before. And February's data did not include any of this. So once our inflation data has had a chance to include higher increases in oil prices, higher increases in food prices, it's more likely than not that this inflation rate is just getting started. So with the US currently at 7.9%, it's very, very likely that Canada is headed in that direction as well. We might have been heading in that direction anyway before the big increases in oil and in food, but we're definitely heading in that direction now. But as for interest rates, the price of gas and the price of food aren't really elements of the inflation rate that the Bank of Canada can control. What Tiff Macklem has said is that the Bank of Canada intends to control what they can control, and that's demand. That's the amount of demand driven by cheap money, by low borrowing cost, and the Bank of Canada does still intend on targeting that to control our inflation rate as best they can.
What monetary policy can do is make borrowing more expensive, which slows domestic demand.
So while the Russian invasion of Ukraine is definitely going to contribute to the upward pressure in our inflation rate, it doesn't look like this is going to stop the Bank of Canada from raising rates. I also think it's really important to remember that whether or not the Bank of Canada is going to raise rates and what our inflation rate is going to be isn't really like the will they, won't they situation that characterized the past 2 years during the COVID pandemic. Throughout the pandemic, we didn't really know what the effect of all the money printing was going to be.
We all knew.
Okay, but we didn't know for sure. We knew that there was talk of transitory inflation. We knew that there was a lot of money printing. We knew that there were supply chain problems. We didn't really know for sure what was causing the inflation, so we didn't know for sure what the Bank of Canada was going to do to tame that inflation down. This time, however, we've seen this before. We saw this in the 1970s when higher oil prices caused inflation to skyrocket, and as a result, the central banks, the Federal Reserve and the Bank of Canada, raised rates to get a hold of that inflation. But how high will interest rates go because of this invasion of Ukraine, because of the sky-high oil and food prices that we're seeing? Well, it's still too early to tell, but Scotiabank, for their part, and take this with a grain of salt because they always predict high, but Scotiabank, for their part, has predicted that we should see between now and the end of 2023 another 10 rate hikes. So they are predicting that by the end of 2022, the policy rate will be at 2.5. Right now, it's at 0.5, and by 2023, we should see a policy rate of 3%. Policy rate of 3% would make rates 2.5% higher than they are now. Right now, the best rate on a 5-year insured mortgage is right around that 3%, depending with all the usual caveats. But it is around 3%, so figure if we were to go, say, 2 points above that, would put our average mortgage rate at 5%, which is definitely not great if you're currently holding a variable mortgage or you do have a mortgage coming due in the next couple of years, as it does look, all things being equal, as though our inflation rate is going to go up and up and up. And whether or not the Bank of Canada will be able to raise rates that high in order to account for this inflation, it remains to be seen. And obviously we're going to have updates on this channel on the inflation rate and on what the Bank of Canada chooses to do to combat these skyrocketing prices that we're seeing. If you want to get those updates on this channel, make sure you click like and subscribe, and thanks so much for watching.